The 80s was the era of the baby boomers, and their investment of choice was equities. The single-generation investment interest sparked the boom of the stock markets. Suppose the millennial generation, like their parents and grandparents before them, decides to put a mere 10% of their savings into cryptocurrency. In that case, we'll potentially talk about $100 billion flowing into cryptocurrency markets. That's the power of generational buying. There could come a time when Bitcoin is valued at an astonishing $10 million per coin by the time this cycle concludes. This bold claim serves as the ultimate explanation as to why cryptocurrency can be viewed as a once-in-a-generation investment opportunity. This concept isn't alien to us. Remember the gold rush in the 70s? When we stopped using the gold standard back in 1971, the cost of gold was a mere $40. Yet, the public could purchase gold for the first time. And when the silent generation reached its zenith, gold skyrocketed to $600. That's a staggering 15 times increase within just 10 years, all down to a single generation investing in gold.
Gold was $40 when we went off the gold standard in 1971. That was the first time individuals could buy gold. And when the silent generation cohort peaked, gold was $600, a 15x in a decade, just by a single generation buying gold. Boomers, we know, bought equities. That was essentially the stock market boom. If millennials put 10% of their savings flow, $100 billion, into crypto.
Think also of the boom in the stock market back in the 80s. We know that the baby boomers greatly contributed to this surge by investing in equities. Now, imagine the financial panorama if millennials invest 10% of their savings, a whopping $100 billion in cryptocurrency. It's a compelling thought, isn't it? In today's world, prime earners between the ages of 35 and 60 control a yearly investment fund estimated at a whopping $1 trillion. This demographic, mainly composed of baby boomers and Generation X, is at the heart of financial decision-making. However, an interesting shift is happening. Millennials are beginning to age into this significant income bracket, offering a thrilling new dynamic to the investment landscape.
I've lined up each generation when they were aged 21 to 35, and I colored each. The red is silent, the boomers are light blue, Gen X is gray, and the millennials are blue, dark blue. Housing starts have peaked with every generation's peak cohort size.
Let's take a historical perspective for a moment. When the silent generation, those born between 1928 and 1945, were at their financial peak, they poured their resources into buying gold. To put it in context, the price of gold rose dramatically from $40 when we departed from the gold standard in 1971, allowing individuals to purchase gold for the first time, to $600. This considerable 15-fold increase over a decade was largely due to a single generation's investment habits. As we moved into the era of the baby boomers, those born between 1946 and 1964, we saw a shift in investment preferences. Interestingly, the first time the boomers hit age 35 was in 1982, a crucial point when they began to invest heavily in equities. Now, let's address the topic of Generation X, a relatively smaller demographic. This generation didn't significantly boost the stock market since their population size was fairly insignificant to create an upsurge. However, we believe that the up-and-coming generation, the millennials, carry a bigger potential to escalate the stock market to greater heights. This is because they prefer growth stocks, which we predict will be the driving force behind a booming stock market until 2038. Generation X demonstrated a stronger liking for hedge funds, reaching their pinnacle with this generation. But the stage is now set for a completely different scene. We anticipate that millennials will soon accumulate savings that reach a staggering $1 trillion. Coincidentally, the advent of Bitcoin in 2016 perfectly timed with the millennials entering their prime saving years. Today, an investment of $1 billion in cryptocurrency translates into about a $25 billion upturn in price appreciation. Imagine if millennials decide to direct 10% of their savings flow, amounting to $100 billion, into cryptocurrencies. The implication is an immense surge estimated at $2.5 trillion per year. Now, consider that cryptocurrency's market cap is around $500 trillion. Considering this, projections are that the value of Bitcoin could skyrocket to a mind-boggling figure of $10 million per Bitcoin by the end of the cycle. And that's where the real excitement begins. Consider this example. If Bitcoin reached just 1%, every coin would cost a whopping $150,000. Not bad, right? Bitcoin has been doing its job, sticking closely to its predicted path. But let's take a moment to think about what could be on the horizon for this promising asset. Now, you might be thinking, isn't cryptocurrency like Bitcoin supposed to defy all established norms? But let's not forget how much the rules have changed over the last 2 decades. Remember when 92% of companies, right before going public, had to be profitable? Nowadays, only 20% are in the green, so that rule is gone out the window. When it comes to private equity, it used to account for only 1/3 of the public market. Currently, it's soaring at 84%, and there's a real possibility that it might exceed the public market soon. In the bond market, there was a time when they were a source of income. However, 80% of bonds in Germany now have a negative interest rate. So, you see, norms and rules are constantly evolving. And that brings us to another compelling statistic in the context of the S&P. Today, a striking 8.77% of the S&P's value is intangible. If you decided to liquidate the S&P right now, you would only receive 20 cents for each dollar. Nowadays, the value of most leading brands hinges on one key factor, which is trust. Some people believe that gold is the sole repository of wealth. Indeed, gold has historically acted as a valuable resource passed down from generation to generation. However, wealth storage encapsulates a much broader spectrum. This includes pieces of art that accrue value over time, real estate properties that provide consistent returns, government bonds that yield even with negative interest rates, and various collectibles that people hold dear. The market value of these wealth-storing assets is staggering, making up a whopping $280 trillion. Such assets are used as safe havens to park one's wealth, keeping finances secure and growing. Leaving aside other financial assets, a new entrant has entered this arena of wealth storage: Bitcoin. Currently valued at $200 billion, Bitcoins are carving a notable niche in the market. So, if Bitcoin were to capture just a mere 1% of the wealth storage market in the future, each unit would be worth an astounding $150,000. From a broad perspective, there seems to be an obvious drift in value transferred towards Bitcoin and other digital currencies. This is a potential game changer for individuals and the entire mechanism of financial transactions and wealth preservation. So, what does all this mean for the future of cryptocurrency? Will it continue to rise and revolutionize the financial world? Or will it face challenges and potentially decline in value? Only time can truly tell. But one thing is for sure, the role of cryptocurrency and its impact on the investment landscape cannot be ignored. As generations shift and evolve, so do their investment habits, which could significantly increase demand for digital currencies.